All right, today I'm going to be explaining HODL waves and what they mean, how it can be used as an analysis tool to understand some macro trends in how people are handling, and in this case, holding Bitcoin over time. So I'll be going into the weeds here and kind of understanding this analysis that was done by Unchained Capital. So Bitcoin uses an accounting structure called UTXO, or unspent transaction output. All of unspent transaction outputs are time-stamped by the transaction block in which they were created. Since Bitcoin is tracked on a ledger, you're able to actually go back through the data and understand when each Bitcoin was last used in a transaction. And that is what we're referring to when we talk about the age distribution of Bitcoin is the time from today or this minute until, going back in time until when that particular Bitcoin was transacted. And across this chart, you can see percentages on the left. So these kind of cross sections of different time intervals make up 100%. And you can see how those time intervals trend over time. It's essentially what this chart is showing. Okay, so what does that really mean? So understanding this chart in a little bit more detail, you can see the colored bands at the bottom represent the most recent transacted Bitcoin. So how much Bitcoin was traded within the last 24 hours, how much within the past day or week. And there's a little bit you can observe there based on the chart, if you remember, on 2017, 2018, and some sell-off behavior. How about in 1 week to 1 month, you can see another band, and so on and so forth. Now notice one kind of interesting thing here. The shape of these curves tends to transcribe through, starts in the, say, past 24 hours. It will show up a similar kind of trend or wave in the later and later stages, but it'll be a little bit phase shifted to the right. And that's simply because, as time progresses, that kind of impulse behavior, that spike, becomes older and kind of washes out over time. So that's kind of a brief explanation of what you're seeing there. So I'm going to get into more detail now, explaining a few particular cases of what we'll call a HODL wave using this data. So a pretty common pattern after every Bitcoin rally has been the price of in the price of Bitcoin is what we're calling here a HODL wave, and that's created by a large amount of Bitcoin transactions on the way up to and through a local price high, becoming recent Bitcoin, and then slowly aging into each later band as its new owner HODLs. Okay. So a HODL wave manifests itself visually on the chart as a pattern of nested curves caused by each age band becoming suddenly much fatter at progressively later times in the rally. The image traces through some of the largest HODL waves. So you can see this Genesis wave here. The wave, again, started, and the wave is kind of basically measured by the thickness of the band. So it's starting here in this region as the fattest, and then the fattest portion of the next band in this, I guess, 6 to 12 months is here, and so on and so forth. And so that's kind of known as a HODL wave or an accumulation wave. So let's take a look at, the Genesis HODL in particular. So zooming in a little bit more here. The first HODL wave, the Genesis HODL, was not caused by a price rally in Bitcoin because Bitcoin had no price at this time. Instead, it was caused by the initial acquisition of Bitcoin by Satoshi and the other first miners. During the first year of Bitcoin's history, the community was extremely small. Transaction volumes were low, and there were no exchanges to establish the US dollar Bitcoin price. The coins being mined during 2009 were included in transactions very often for these reasons. Were not included very often for these reasons. They sat around and progressively accumulated into larger bands. Consequently, each colored band appears if it's appeared suddenly in the diagram once sufficient time had passed since the genesis block. The green 12 to 18 month band appears exactly 12 months after the genesis block, for example. The age band grows for a time, then begins shrinking as all existing Bitcoin ages into the next band. Because there was nowhere to sell Bitcoin at the time, the Genesis HODL is one of the clearest HODL waves on the chart. No early miners had no choice but to HODL their Bitcoin and surf the wave. Later HODL waves were much frothier as HODLers could exit into fiat whenever they wanted to. The first time this pattern shifted was mid-2010 going into 2011. The first Bitcoin exchanges, including the infamous Mt. Gox, launched in 2010. Bitstamp, Kraken, Coinbase all launched in 2011. The fraction of coins older than 12 months stopped growing in June of 2010 for the first time. This is known as the era where hodlers could trade Bitcoin online. Bitcoin's price wouldn't reach even $1 until February 2011, but early miners likely had many thousands of Bitcoin. Why not make a little cash? Okay, so now we'll go a little bit more recently into history here. They're calling here the HODL of 2011, which was June 2011 to December 2013. The price movement here was $33 to $1,000 on the coin. So starting in June 2011, Bitcoin's price suffered its first major collapse from $33 all the way down to $2 to $3 by November 2011. It took almost 2 years to recover when it rallied to $198 in April of 2013. During the rally up to $33 in June of 2011, all the holders who sold were early miners by definition. No one could really have acquired Bitcoin to sell it other than mining. So the rally up to $198 was different. The age bands which shrunk the most leading up to the rally were between 12 and 24 months. These were likely the first waves of investors, not miners, selling to realized gains. These investors have acquired their Bitcoin leading into the prior $33 price rally and afterwards. So Bitcoin collapsed again in 2013 down to $69 in July 2013, only to soar past $1,000 by December 2013. There wasn't much time for panic selling before a new surge of euphoria. This was the first major rally that was covered in the news. Many major exchanges such as Bitstamp, Kraken, Coinbase, not to mention Mt. Gox, have been around for a few years and were mature enough to service a large wave of demand for the first time. Right after the $1,000 rally, more than 60% of Bitcoin had been spent within the last 12 months. This was the most recent moment for Bitcoin's money supply in history. The moment at which the average last time of use of Bitcoin was lowest. Who sold? Once more, it was investors who purchased in the prior 2 to 3 years through the 33 peak and the $198 peak. All right, let's fast forward a little bit more here. The Great HODL 2013 to 2017 from $1,000 to $19,000. The long winter of Bitcoin. After collapsing in December of 2013, Bitcoin wouldn't reach $1,000 again until February of 2017, more than 3 years later. But the rally to 2019, reached by the end of the year in 2017, was truly spectacular. There was much more mainstream press coverage and many more new investors, including some extremely traditional investors, such as institutions and funds. As the price was crossing $1,000 in February 2017, almost 60% of Bitcoin was older than 12 months. A year later, just after the peak of $19,000, only 40% of Bitcoin was older than 12 months. During 2017, just 20% in existence with was transacted with for the first time in years. Why? We see three separate reasons. One is capturing gains. Some of the transactions in 2017 were about capturing gains. Investors who'd held Bitcoin for 12 months or more were the sellers, with particular emphasis on those who'd held for 2 to 5 years. Fully 15% of Bitcoin moved out of those large age bands and became young again during this rally. The selling started as soon as Bitcoin crossed $1,000 again in February 2017. Another reason was ICOs, which I won't get into right now. Okay, let's go to a next chart here. Bitcoin Cash and segregated witnesses. The final factor of that movement was due to Bitcoin Cash hard fork on August 1st, 2017, and the subsequent upgrade on the Bitcoin side, using segregated witnesses. Both these events caused a large amount of Bitcoin to transact for the first time in years as holders acted to claim coins on both sides of the fork and move their Bitcoin to new SegWit addresses. Data clearly shows the significance of this event. In the month of August 2017, 25% of Bitcoin became less than 1 month old. That equates to nearly 4 million Bitcoin or $17 billion of value at those prices. Okay, and now we'll get into kind of the interesting part here, the current state of affairs. So 2017 onwards. After the rise of Bitcoin price in 2017 and the fall in 2018, the fraction of Bitcoin older than 12 months has dropped to just 40%, making the average age of Bitcoin almost as recent as it was just after the big rally to $1,000. And after every great rally, there's been a great HODL. The data shows us there's already development of another generation of hodlers settling in for the long haul. Beginning in January 2018, the category Bitcoin hodlers that are 6 to 12 months old rebounded from 7.76% to 14.63%, doubling in population. It'll be interesting to continue following the HODL waves over the next few months and years. What price will be required to break the next wave and begin the next cycle? Okay, so let's take a look now at the current chart. So we were just talking about some periods back here where you had a large spike in the activity in some of the most recent time intervals. And these kind of spikes transcribe themselves into larger bands as time moves on, higher up on the chart. So we have here where this peak was in 2011. Then we had what would be a HODL wave here, where essentially that dissipated and people began to hold the coins. And that was, of course, the indication that the next spike was brewing. Of course, we had that here as well. You can see that distinct U shape, this green, fattening green bar. This was another HODL wave that caused a very kind of abrupt run up in 2017. So what's interesting here is we're starting to make that out again in the latter stages of 2020. We're seeing a lot of fattening of some of the waves, in the center portion of the chart, which could potentially indicate that there's some accumulation behavior going on. All right. One thing that's particularly interesting here, we take a look at single bands. So if we just look at this, let's take a look at, yeah, let's say 6 to 12 months. Actually, let's take a look at 1 to 2 years. Okay, so everything above this yellow band is Bitcoin that basically has been held for 1 year or longer. You can see the lowest point on this chart occurred maybe 6 months ago, in 2020. Now, what that signifies is the greatest portion of history of Bitcoin of all time has recently been greater than 1 to 2 years old. So, in other words, more Bitcoin as a percent of the total Bitcoin outstanding is older than is has not been transacted in 1 to 2 years or longer than at any point in history. So that shows that there's just more and more holding behavior. There's a compression on supply, and also, that'll certainly uh, tend to drive up prices of Bitcoin. But another point is, as you look at kind of the overlaid price chart behind this graph, you can see some of the fattenings of this 1 to 2 year band tending to be before a run up in price. And a significant fattening or thickening of that band tends to lead to a run up in the future after that holding behavior has accumulated for some time. So I thought this was interesting. That kind of compression of the available Bitcoin is a very, very strong scarcity piece, and why Bitcoin is a more and more scarce, hard to come by, and therefore more valuable asset over time. So it'll be interesting to follow this over the next few cycles. If anyone has questions or wants more explanation, leave a comment below.